Tesla earnings strategy when it comes to options, course number 1. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. Repeat visitor, welcome back. We actually also want to thank our Patreon supporters as well as our subscribers. If you enjoy the show, please take time to like and subscribe. For those of you who are on Patreon, we also have some new tiers. We're actually going to be introducing a top tier where we do once a week telephone calls in no more than a group of 5 or 6 people. And we'll update you on the Patreon level for that shortly, but wanted to let you know that's coming up. So I wanted to also review with you the fact that I don't respond during the show, only afterwards typically, and would love questions after the 20-minute mark. The folks that watch after the live show appreciate that delay. We also want to encourage you to keep the conversation on Tesla / kind of focused on the topic rather than roaming far afield. Otherwise, we may have to sort of cancel you on the channel. So one of the most difficult parts of doing shows like these is that there are certain groups of people who are very sophisticated and you can say one thing and they know everything you're doing. There's another group that's just learning what you're talking about. So you're kind of way too low for the really smart people and way too high for the people that don't know a lot. So I was encouraged by Pamela, who I see right now, to make an effort to sort of share a little bit more on what's going on. And I particularly wanted to share now because we're in a very important time for Tesla. So what I'd like to ask, first I want to go for the 5 commandments of a good trading / investing. And that list could actually go 10, 20 deep. I'm just going to choose 5 that I think are important. The next thing I'm going to do is walk you through what's called an options trade, sort of a basic step through of an option. The technique I'm using is to just look at a house purchase, because you're trading options when you buy a house, even though you may not realize it. The third thing I'm going to be doing then is sort of surveying to see, one of our viewers, Pamela, had suggested that we consider doing a separate channel for sort of beginning investors to understand sort of fundamentals. So there are a couple of things if you want to be successful. Well, I've been thinking about doing a book. I started one, did not complete, so several people have asked about it regarding trading options. Part of the problem is how do you target the levels, because everybody's at a different level. And so what I've been doing instead is sort of introducing ideas and different things that you could use as a way to understand how it works. So today, I'm working off the plan I just described. So the 5 commandments of good trading investing. Number 1, if you have your money with a large broker, call it Fidelity or Merrill Lynch, any of those big companies, what you want to do is open up another account like a TD Ameritrade, E-Trade, one of those other accounts. The reason is that you always want to have a secondary place you can trade, because you may get better prices at that other location versus the one you're at, and having some money over that other location would enable you to sort of trade in that account and not necessarily just yours. The second thing is that I'd like to encourage you to do is have phone access. So if you choose a company, again, it could be Ameritrade, it could be Fidelity, any of these guys, they charge you more to trade by phone. But the problem is that if you do by computer, basically what happened is I stopped exclusively trading on computer because I was with Schwab, and they kept doing this thing where I put trades in, and they would sort of screw you over on the computer trade. But if you do the trade by phone, when you call in on the phone, they can see the screen. So absolutely. Okay. As we get to this options thing, I'm just explaining to you, I'm not saying you're going to do it. I want you to understand what's happening, and you can choose if you choose to use it, because you actually have to apply before you can even get in. And so the the thing that I wanted to next mention in terms of the commandments is just the fact that you want to have phone access. And the reason is that it turns out that when a trade is going on, the traders on the desk can actually see how many users trading, price points, etc. And you can get sort of real-time information as you're doing your trade that allows you to execute the trade better. That's the good part. The bad part is you have to pay 2 or 3 or 4 times more. The issue, though, is that it's the difference between spending $5 for the trade and spending $30 for the trade. But if you're dealing with thousands or hundreds of thousands of dollars, the extra $20 is not a big deal. So don't let the price difference, have an influence. Have 2 different entities you can trade with at least. Now, this is for people with reasonable portfolios. So if you have 5 or 10 grand, you really can't afford to do multiple locations because the money is split so broadly in terms of your trading. I'm kind of looking at 30 grand and up. So maybe you put 5 grand in one account, that's a smaller firm, and then your main one would be over on the other side. So at least 2 accounts, phone access, very big deal. You want that option, not that you're going to use it, but what'll happen is there'll be different trading situations. So for example, once Tesla announces tomorrow, or just before they announce and just after they announce, you'll find that the volume of activity may be so great that you really can't do it by computer. So having phone access is a very big deal. And so you'll find no big deal, and then a very short period of time, very big deal. And so it's nice to be able to do things if you need to. And that's on options or stocks. The third commandment that I would say is buy yourself a tape recorder. And the reason you don't have to buy one is you can record using your phone the conversations you have with the brokers on phone. But I want you to purchase the tape recorder slash, again, it can be another phone, whatever the device is. Because when you have that conversation with them, the conversation is going to be recorded by the company, but if they screw up, you want to be able to have that conversation on tape. That way, everybody knows what occurred if they do screw up. Or frankly, the other side, if you screw up, you have, hey, I knew what I did wrong, I should have done X, Y, or Z. The third thing I wanted to note to you, in terms, I think we're at 4 now actually. The fourth commandment is, you always want to earn more, but it's never a bad thing to take profits. The problem with profits can be that when you sell the stock or the option, you generate a taxable gain. So you could want to make your moves driven by whether or not you'll be taxed. The thing, though, is that don't get caught up so much in your trade that you end up worrying about the taxes so much that you lose all your money waiting for these other taxable circumstances to come up and work out well. So be mindful of that, again, whether you own stocks or you own options. The fifth thing, and I'm going to leave it at that, is that you kind of have to be a student of the game. So you really want to try to keep learning, because all that learning is going to enable you to handle your money better over time. So the basics are this. I am looking at doing another channel. Will allow people to subscribe, but I kind of don't want you on my channel unless you've read a book called One Up on Wall Street by Peter Lynch. The other book would be Beating the Street. The reason I want to do it that way is that I want to make sure there's at least a basement of understanding of fundamental investment strategy that Peter Lynch talks about. The book's only 128 pages long, so order it, read it. Fantastic book, because the questions I can answer and what I can cover totally changes if I know that there's a floor to what everybody knows. So I want to encourage you to Peter Lynch, One Up on Wall Street, read it. The second book is a book by Talib called The Black Swan. So Lynch will teach you how to invest your portfolio well. And then the Black Swan starts to walk into things people do when they're trading options. So that's another level, different party. but the basis of the options tends to be fundamental, analysis, and Peter Lynch and his crew, really do that well. So one of the reasons I was compelled to do another show today is the fact that we're at the point now where Tesla's about to do earnings tomorrow. Guess what's going to happen? Next year, they're going to announce around the same time. The following year, they're going to announce around the same time. So I want to encourage you to sort of journal for at least, whatever comes to mind, whatever you're seeing, whatever you're hearing, for at least 1 or 2 pages for today. Same thing for tomorrow, same thing for 2 or 3 days after earnings. The reason I want you to do this is that there's all kinds of information that'll be flooding at you. You're going to get analyst reports. You're going to get the stock moving around like crazy and different people saying different things. And so by developing a portfolio of experience over time, you'll get really comfortable with trading in general. So get back to this and just point out that the issue that comes up is that you want to develop over time a command of the company, the tendency of trading for their stock, what does or doesn't happen. You're going to get those numbers from a lot of different places, but there becomes a point where you kind of get a feel for what's going on that's both normal or not normal. So very important thing, journal, meaning take a piece of paper, write down what you're thinking right now. We're a day before earnings. You've seen a bunch of earnings report. The stock has bounced around a lot. It's actually been up nicely. Next year, the question I'm going to ask you is, do you remember what happened the day before earnings were announced and where we were and what your expectations were? And then you'll be able to read your notes and say, oh, that's what I was thinking. That's what the marketplace was thinking. This is where the stock was. And then same thing for tomorrow as we're going into earnings, same thing the day or two afterwards. Now, the last thing I want to note in our pre-session here is what I call the, I sort of just lost my thought, but in general, you're making notes heading into large activities being experienced with that company. And definitely Tesla has a lot of information to provide that's going to really shift things around a ton. So you really want to be ready for it. So, wow, I kind of have an emergency project going. Give me 1 minute, folks. I just have to say something. So what I further wanted to cover, and I apologize for the delay here, is I want to jump into an options lesson for the day driven by what you've been doing when it comes to houses. So right now, what's happening is that there's someone buying a house. The price of the house is $100,000. Okay? So I'd appreciate it if you want to write this down because it's going to make a huge difference in your understanding what's happening. So let's say the house price is $100,000. You've put $5,000 down. Okay? So what is also a part of that $5,000 is that when you sign for your $5,000 down, you also get approximately 90 days to complete that loan. Okay, so for those of you who purchased a home, what then happens is you go to your bank, you do your due diligence about the property with the help of the bank. Then after X number of days, you get your loan and you go to purchase the house. When you go to purchase, There's a down payment amount. So I'm not going to get into those kind of details. Let's just stick with the fact, let's say the down payment was 5,000 that you put down. So basically you've got a loan for $95,000 and now they turn over the keys to you and you're now the owner of that property. So what I wanted to run by you is the fact that, guess what? Let's go back and look at the purchase of the house that you were doing. Number one, you just put up, you were able to control a $100,000 property for $5,000. That's called leverage. So when you're doing your mortgage, you have a you have a problem, and the problem is that you know, well, not a problem. You basically have a very small amount of money that's controlling a huge piece of property. So you only put up $5,000, but you're controlling a $100,000 asset. So you have a sense there that's called huge amounts of leverage. So guess what? That transaction that was done was an option. And so an option has three components of pricing. Number one is, let's say right now Tesla stock price is at 570, okay? So one of the pricing elements is proximity. So if you buy an option that's at $570, that's going to be very expensive because it's already there. Let's say a call option or a put option. In this case, we're just focused on call options because we'll get into puts later. So what I want to review then is that the challenge you have is what strike price do you use for your options? The closer it is to the current stock price, the more expensive it is. So if you choose to buy, let's say, a 600 call on Tesla, it's cheaper than a 570 call because you're not right on the price or proximity to price. So in the case of the house example we just gave, so basically what's happening right now is that we have a $100,000 home that we're controlling. For $5,000, we got 90 days of time, okay? If I wanted to have a month, or if I wanted to have a month of time, I'm gonna have to put up $1,000. I'm gonna have to put up less because the time I get to do is way lower. So there are three components: proximity to price, time, and what's called delta. So time in this case is 90 days, which is item number 2. Number 3 is what's called delta. So the house that we're dealing with really doesn't have a delta because we know what the price is and you've already locked it all in, which is a very nice option, if you will. It's a stock, in this case, a house that has low volatility. So what I wanted to review with you next is the fact that that delta component that we see with a stock is at the highest point just as Tesla's about to announce earnings. And it's also one of the most painful parts of trading because as soon as the announcement is made and everybody knows the details on earnings, the delta portion of price drops to zero. And now we're just dealing with basically time and time out and proximity to price. So delta will be sort of apexing at the peak of price right there before they announce earnings, because it's the most risky when nobody knows for sure what's going to happen. We have a pretty good idea, but nobody knows for sure. So what I'm thinking about right now is that I'm kind of wanting to use this as an intro in general to what might occur. So there's an instrument called a call option, and that's kind of what we just did with the house. We're saying that thing is going to be worth more, that's why we're buying it. But there are other possibilities, like what if they found a toxic waste dump under that house, right? That value of the house would drop, and your obligation would only be for $5,000. right? Now, the other side, what if they found gold bars, a million of them underneath the house? Now the value would spike, and you're controlling that property for only $5,000. So all that extra gain belongs to you. So the only thing I wanted to say about what's going on with Tesla right now is one of the reasons why everyone loves to trade Tesla, be it the shorts and others, is something called delta that we've talked about before, which is the more volatility there is, there are certain traders who understand how to manage that volatility profitably. And that's why I want to bring you guys into some knowledge of this, is that if you understand the company well, if you carefully take time to understand what it tends to do, you could certainly lose your money. But what we're suggesting is that you have the potential to understand what's going on and therefore be able to trade that situation better. Now, why am I trying to drag you into options when you may not trade stocks that heavily? And the answer is that it turns out that you're kind of, sometimes the companies and their stock prices move so far dramatically during earnings that having some command of what's going on with the options allows you to now make money where otherwise you completely miss the opportunity of trading whatever the instrument may be, or trading into and out of that stock. So this is the conversation I've chosen to have today, sort of as an intro. Obviously, I've covered 10 commandments of good trading in terms of having a secondary source, in particular because number one, you might get better execution, but you also may get better pricing by having that second entity. I know it feels weird. It's a loyalty thing that you may have. The challenge, though, is that there are actually a lot of companies that are really lining up products you get offered, et cetera, based on what's optimized for them. So if you have a portfolio, you'll notice that the funds and all the other things they're trying to sell you belong to the company because they make more money on them. And the trend is that this can also be the case when it comes to other aspects of the interaction with that firm. So it's a good idea to have that secondary entity. And then I'm not going to go through the rest of the 5 lists. I just wanted to review that component with you. At any rate, I'm going to leave it at that today. Look forward to your questions after show where I can post any questions. We're going to go back into this again tomorrow, heading into what happens. The one other encouragement I would make to you is try to take a look at the data flow. So there are a couple of other numbers you want to write down someplace because you're going to look at them again next year. Number one, note what the average number of shares traded for the company you're dealing with. In this case, is Tesla. And number two, on an hourly basis, starting now if you can, but definitely tomorrow, note the volume of shares traded all day on an hourly basis. And then once you get into after earnings the next day, watch how many shares have traded. The apex time for the trading of that stock is going to typically be when big news like earnings hits, and that's 4 times a year. So if you're understanding the data flow of how many shares are trading, all these different things, there's a lot of different moving parts. You now can sort of start getting a feel for what happens typically with the stock. Can you access this information online? Absolutely. NASDAQ, Yahoo, your own brokerage firm is going to offer you historical data like this. But there's this thing about sort of feeling different data points all hitting you at the same time that's going on now. And this is why I'm saying it's great to journal on a daily basis so you have a really good command of everything that's going on. At any rate, I think we're going to close down with that. If you guys have any questions, I will follow through before we close out. Just a reminder, don't forget your 25 leg lifts. Don't go to bed within 2 hours of eating. 25 leg lifts per day, great idea. Reduces potential for knee issues. Wanted to, ask for feedback. Was it helpful or not? If not, that's cool. But there were a number of people. There's one person asked a question that I forgot to add, and I wanted to note, and that is something called pinning. And what that means is there's a company called Tesla. Its stock price is at 570, let's say right now, okay? It turns out that there is a possibility that there are certain companies that are powerful enough that could say that stock price is going to end up at 569.50 today. And they have so much power that they can use both money and trading technique to force the price to be at $570.50. Why do they want to do that? Because it turns out, remember the call options we were telling you about at 570? Those options end up expiring worthless. So I mentioned market makers. There's a big word called market makers. It just means big firms. And what I want to highlight is the fact that those guys have the power to do whatever they want in a very short-term window. And so the challenge is smaller traders are sort of victims, if you will, of those big guys. And so you just have to be mindful of the fact that things can happen where you're almost making it into the money for your call or put option, and all of a sudden you get screwed, and you're like, this can't happen. Oh, yes, it can happen, is what I was thinking about. So it's interesting. I have to admit, S&P can do a lot of things. I think everything is big news on Corona or not. And so I'm not even going to mess with the S&P because it's not my focus. I have a few stocks that I follow. I know their shares. I understand what happens during different points of the year with them. And obviously one of them is Tesla. So I could say more about that than others. So we'll see what happens. I'm actually looking forward to your questions after watching this, because then I can use those to guide the next show we do that's exclusively focused on investing/trading. And we look forward to following up on that. Here's a question about how do we monitor volume after hours. Excellent question. One of the things you can do is on 5-minute or 10-minute increments, just go on to Yahoo, for example, is one that I used a lot over the years, and just type in the TSLA Tesla stock symbol, and it'll show you, what's happening after hours. It's usually a half-hour session, I believe, afterwards. So what he's asking about is that at the end of the trading day, which is 4 o'clock, there's what's called after-hour trading for about a half hour. And as a consumer, you can see the trading happening where people who, like Fidelity, could trade with Merrill Lynch, and they have shares that are going between them. So it's usually a professional trading environment that happens at the end of the day. So one of the big arguments by consumers is we'd love to be able to trade after hours. So after earnings come out tomorrow, only the professional traders would have access to that trading space, and the novices or consumers like ourselves do not. And so they can sit there and go back and forth. Now, if you look at it, there are a bunch of people that watch us around the world. So one of the sneaky things you could actually consider doing is opening a brokerage account non-US. That way you could trade in markets that are still open comfortably without the headache of getting shut out of the US market. So if you have a lot of money, you can start playing around with having brokerage accounts available in different parts of the world that you can leverage into information that's happening in the US market. And that's actually just a smart move if you choose to do that. But it does cost money to do that. Any rate, so I hope you guys know what pinning means, which is being able to pin a stock price at a certain number, and it isn't being allowed to normally float. And that's what's excellent question. What I consider calls or puts to hedge. What hedging typically means is I own 1,000 shares of Tesla. I've made a bunch of money. What do I do to protect or hedge my gains? So in this case, if you have the stock, hedging would mean you're just buying puts to in case the stock price falls, you get money back from those puts rather than losing all that value in the stock that you own. So that's the definition of a hedge, is sort of the other side of the trade you're doing. So that's kind of that works. The one other thing to note here is that when it comes to the puts and calls, they're being issued by large institutions or individuals that with a lot of money. So as we shared, they're trying to make as money as they can. So if those things expire worthless to you, that value is being kicked back to the entity that created them. Hence, one of the reasons why they would want to try to pin the price into money losing for as many people as you can. Um, Graham asked about spread bet. The only thing I can think of what he means for that is the idea that, let's say you have a stock at 570. Um, you know, there's an interesting phenomenon where there's a put, there's a call. You could buy a 550 put and a 600 call. So that there are concepts called straddle. You could actually buy two calls, one at 570 put, one 570 call. And it doesn't matter which way it goes. If you have enough change or a delta, you make money on one, lose money on the other. So that's the best guess of what I have for what you just said. I'm not claiming to be total expert on options and the level of experience of folks here. I was really targeting people on the learning how to trade better or invest better and increasing security and potentially increasing profitability. So I'm looking forward to comments afterwards because people will be adding sort of input based on their expertise, and I think that's fine. I I think I'm going to take questions afterwards from here because I kind of have an emergency I've got to go deal with, hence the calls. But what we're going to do is revisit this tomorrow and also field your questions afterwards. This is Greg for Teslafaninsight. Tschüss, German au revoir, French Leith Road, Hoda Hafez, Hedge Do. There's a last question here of will the stock price fall? There's a rule that's emerged on Tesla. What you should expect to happen to Tesla is what everyone is seeing. There's a whole bunch of information flowing on Tesla. The trend for Tesla is what you expect, the opposite is occurring. So if you expect it to drop, it rises. If you expect it to rise, it drops. So part of the issue with hedging is you manage your process better by having other instruments with which to do it, hence why we're suggesting learning a little bit about what options are doing. Any rate, have a great day. Bye for now. Thanks again for your time. This is Greg for Teslafaninsight. In Jamaica, we say enough respect, walk good man.